Hello and welcome. Today we're unpacking George Garr Henry's practical guide, How to Invest Money. I'll walk you through the core principles that turn hard-earned savings into long-term wealth. We'll cover everything from setting goals to choosing the right mix of investments, all in a friendly, conversational style. Think of this as a chat over coffee. No jargon, just clear steps you can use today. Let's dive in. 1. Why invest? Planting seed for tomorrow. Money that works while you sleep. Imagine your money as seeds in a garden. Left in a jar, they sit dormant, but planted wisely, they sprout, grow, and multiply, giving you a harvest year after year. That's the power of investing. Your savings grow through time, unlocking opportunities like home ownership, education, or early retirement. For example, if you set aside £200 a month into a growth fund, earning just 5% annually, in 20 years, you'd have over £80,000 more than double your contributions, thanks to compounding. 2. Setting your course, goals, and time horizon. Charting your investment voyage. Before buying a single share, ask, what am I investing for? A rainy day fund? A deposit on a first home? Retirement? Your goal shapes everything else. Short term, 1 to 3 years, preserve capital, consider cash accounts or short-term bonds. Medium term, 3 to 10 years, balanced growth, mix of bonds and equities. Long term, 10 plus years, higher growth potential, lean more into stocks. Metaphor, if you're catching a local bus, short ride, you won't pack heavy luggage. For a cross-country trip, long haul, you prepare differently. Same with investments. 3. The core triad, asset allocation, the heart of your portfolio. Asset allocation, how you split money among stocks, bonds, and cash, is the single biggest driver of returns and risk. Henry highlights 3 buckets. 1. Equities, stocks, ownership in companies, higher returns, higher volatility. 2. Bonds, loans to governments or companies, steadier income, lower swings. 3. Cash and cash equivalents, bank accounts or short-term debt, low returns, high stability. Rule of thumb, a simple guideline is 100 minus your age in stocks, the rest in bonds and cash. So a 30-year-old might hold 70% stocks and 30% bonds and cash. 4. Diversification. Don't put all your eggs in one basket. Spreading out your risk. Within each asset class, diversify. Buy shares across industries and regions, tech and healthcare, UK and emerging markets. Hold bonds of varying maturities and credit quality. This way, a setback in one area is cushioned by stability elsewhere. For example, if oil prices plunge, energy stocks may tumble, but your consumer goods or tech holdings can soften the blow. 5. Cost matters. Fees eat returns. Keeping more of what you earn. Henry warns that high fees can erode decades of growth. Actively managed funds often charge 1 to 2% per year, while many index funds cost as little as 0.1%. Over 20 years, that difference can mean tens of thousands less in your account. Metaphor, think of fees like termites in a wooden house. Small at first, but over time they can hollow out the structure if left unchecked. 6. Risk tolerance. Know your comfort zone. Finding your personal balance. Risk tolerance is how much market ups and downs you can stomach without panic selling. If you lose sleep watching your portfolio drop 20%, you're likely too heavy in stocks. Conversely, if you shrug off volatility, you might accept more equity for higher long-term gains. Exercise. Review your reactions during past market swings. Adjust your allocations so you can stay the course when markets wobble. 7. Tax efficiency. Keep more of your gains. The invisible returns booster. Taxes can take a big bite out of profits. Use tax advantage accounts like a stocks and shares ISA in the UK or an IRA or 401k in the US to shelter dividends and capital gains. Outside those, employ tax loss harvesting. Sell underperforming assets to offset gains elsewhere. Tip: check each year whether your contributions to tax-free accounts are maxed out. Missing out is like leaving free money on the table. 8. Rebalancing. Tuning your portfolio back to tune. A financial tune-up. Markets don't respect your original allocation. If stocks surge, they may grow to 80% of your portfolio when you intended 70%. Periodically, say once a year, sell the overweight assets and buy underweight ones to restore your target mix. Metaphor. It's like pruning a garden, trimming back overgrown branches and reinforcing weaker plants so the whole garden stays healthy. 9. Emotional discipline, your greatest asset. Triumph over market emotions. Markets move on fear and greed. Henry emphasizes a rules-based approach. Stick to your plan, don't chase hot tips, and resist panic. Use automatic contributions and dollar-cost averaging. Invest a fixed amount regularly so you buy more shares when prices are low and fewer when high. For example, during a market dip, new investments buy at discounted levels, lowering your overall cost over time. 10. Building your investment toolkit. Practical steps to get started. Choose your platform. Online brokers today charge minimal fees and offer a range of funds. Select funds. For most, a handful of low-cost index funds, domestic equity, international equity, and bonds covers broad markets. Automate savings. Set up monthly transfers so investing happens without you thinking. Educate yourself. Read annual reports, follow reputable financial news, and revisit your plan yearly. Metaphor. Think of it like building a recipe. A few staple ingredients, a reliable process, and regular taste tests to adjust the seasoning. Wrap up your wealth building roadmap. And there you have it. How to invest money distilled into practical wisdom. 1. Set clear goals and time horizons. 2. Allocate assets between stocks, bonds, and cash. 3. Diversify within each category. 4. Minimize fees with low-cost funds. 5. Match your risk tolerance to your allocation. 6. Use tax-advantaged accounts and techniques. 7. Rebalance regularly to stay on track. 8. Practice emotional discipline. Automate and stick to your plan. 9. Build a simple toolkit of funds and an easy process. Remember, investing isn't a sprint, it's a marathon. Start today, stay consistent, and let time and compound growth work in your favor. Your future self will thank you for the seeds you plant now. Thank you for listening, and here's to your journey toward financial confidence and growth.